There's this system. It's been around for over 500 years, and it's basically the engine behind every single successful business. It's like a universal language for money, and it lets any company tell its financial story with total accuracy. So today, we're going to dive in and break down exactly how this thing, double entry bookkeeping, actually works.
Think about it for a second. How does any business, from a tiny little guest house all the way up to a massive global corporation, how do they keep perfect track of every single penny? Seriously, how can they be sure that nothing, not 1 cent, has slipped through the cracks? Well, the answer is this surprisingly simple but absolutely brilliant system.
All right, so here's how we're going to tackle this. First, we'll get into the whole two-sided transaction thing. Then we'll look at the unbreakable equation that makes it all work. After that, we're decoding debits and credits, putting it all into practice, and finally, we'll see how all the accounts get organized. Let's do it.
Okay, let's start with the big one, the two-sided transaction. Honestly, this is the absolute heart of the entire system. If you can get your head around this single idea, I promise everything else is just going to click right into place.
So what does that even mean? Well, at its core, it's just this. Every single financial thing that happens has two sides to it. It's that simple. Think about buying a coffee, right? Money leaves your wallet, that's one side. But a coffee comes into your hand, that's the other side. It's like a financial seesaw, where every action has an equal and opposite reaction that keeps everything perfectly, and I mean perfectly, balanced.
And that brings us to the golden rule. Seriously, if you walk away with just one thing today, let it be this. Every debit has a corresponding credit. That simple phrase, that's the system's built-in self-check. It's what makes it completely foolproof. No exceptions, ever.
All right, so we've got the golden rule. Now let's look at the math that actually proves it. This is what we call the unbreakable equation. It's basically the blueprint that guarantees the books stay balanced, always.
And here it is, nice and simple. Assets equals liabilities plus capital. So what does that mean? Well, assets are all the things a business owns. It's cash, it's buildings, it's computers. Liabilities are what it owes to other people, like bank loans. And capital? That's just the owner's skin in the game, their investment. So think about it. Everything you own has to equal what you owe to others plus what you've put in yourself. It just has to balance.
Okay, let's make this real. Imagine a guest house buys some new furniture for $20,000 in cash. Now what's happened here? The guest house has a new asset, the furniture, so that goes up by $20,000. But it used cash to buy it, and cash is also an asset, so its cash asset went down by $20,000. One asset goes up, another goes down by the exact same amount, the total value of their assets hasn't changed, and boom, the equation is still perfectly balanced. So we've been throwing around these words, debits and credits, but what on earth are they really? It's time to decode this language. And listen, quick heads up here. You've got to forget everything you think you know. Debit does not mean bad, and credit does not mean good. It's not like a credit card statement. In accounting, they are just directions. That's it. Think of them like left and right. Okay, look at this chart. This is basically our Rosetta Stone for accounting. You can see that to make an asset go up, you debit it. But to make a liability go up, you credit it. I know, that might feel a little weird at first, but trust me, there's a solid logic to it. And the good news is, there's a super simple trick to remember all of this.
And here it is, the secret decoder ring. Dead click. It sounds a little strange, but it's brilliant. The dead part is easy. Debits increase expenses, assets, and drawings. Drawings, by the way, is just a fancy word for when the owner takes money out for themselves. Then you have click. Credits increase liabilities, income, and capital. Seriously, burn this into your brain and you'll be able to figure out almost any transaction that comes your way.
All right, that's enough theory. Let's get our hands dirty and see how this actually works in the real world. We're going to put that dead click rule to the test right now.
Okay, first scenario. A retail shop buys $5,000 worth of inventory. But here's the twist. They don't pay cash for it. They buy it on credit. So now they owe that money to their supplier. So the question is, how do we record that using our new rules?
Let's break it down. First, the shop got more stuff to sell, right? Its inventory, which is an asset, went up. And what does our dead rules say? To increase an asset, you debit it. Okay, so that's one side. At the very same time, the money it owes to the supplier, that's a liability, also went up. And our CLIC rule tells us that to increase a liability, you credit it. So you debit $5,000 and you credit $5,000. See? Perfect balance. Let's do another one real quick. A fisherman sells some fish and gets $2,500 in cold, hard cash. Pretty simple, right? So, what are the two sides of this transaction?
Okay, let's apply the logic. The business's cash, an asset, went up, so we debit it. That's the dead rule. What else happened? Well, the business made a sale, which means it earned income. So its income went up. And what does our CLIC rule say about income? You credit it to show an increase. So debit 2,500, credit 2,500. Are you seeing the pattern here? It's beautiful. It just always works.
Okay, so we're getting pretty good at recording transactions. But you might be wondering, where do all these debits and credits actually go? That brings us to our final piece of the puzzle, how we organize everything into a nice, neat, logical filing system. Believe it or not, every single account you can think of in a business, from cash in the bank to salaries paid, fits neatly into one of just three main categories: personal, real, or nominal. Let's take a quick look at what each of those means. It's actually super simple. Personal accounts, therefore, well, persons, and other companies, your customers, your suppliers. Real accounts are for real things, your assets and liabilities, like buildings and loans. And finally, nominal accounts are for your income and expenses, like rent you receive or salaries you pay. And this clean way of organizing things, this is what lets a business go from just plugging in numbers to actually understanding its own financial story. And that really is the big idea here. This whole system with its debits and credits and balanced equations, it's not just a bunch of boring rules. It's a language. It is the language businesses use to tell their story, financially speaking. It allows them to do it with complete clarity, with total integrity, making sure that every single part of the story is told and accounted for. So I'll leave you with this question. Now that you've got a key, a decoder for the fundamental language of business, what stories are out there waiting for you to find? What could the numbers really tell you about where a company has been, where it is right now, and maybe even where it's going?